Welcome to the Weekly Notebook Review. I am Robert McGroarty. This podcast takes on a bit of a different format where we are live each week on Twitter Spaces. I crack open my notebook and review Hedgeye research with anyone who wants to learn a better way to invest. We feature both Hedgeye power users as well as some special guests that might pop in. If you want to learn more about our research, visit hedgeye.com. If you'd like to participate in the live stream, follow me on Twitter at HedgeyeRJM. Now, let's review the data.
Good evening. 5 minutes late here. Apologies for that. Two things happened. One, my children are still awake, and so bedtime has not been going as smooth as possible. And two, I really actually thought this WNR was at 8:30, so that's a little bit of my bad. And so with that, we'll kind of get things rocking and rolling. So apologies for that. But yes, thanks to X2, he just texted me and was like, "Hey, is WNR happening?" And I was like, "Well, yeah, in 10 minutes. But then I realized that I set the reminder for 8:15. So my apologies to all of Hedgeye Nation. It is Wednesday, August 16th. This is been quite a start to August, and we got a lot to talk about tonight. I think there's definitely some signals here that have shifted, and definitely worthwhile in terms of calling them out and assessing what we do next. So, got a lot of friendly faces out here. Again, these sessions, these weekly notebook reviews started as members of Hedgeye Nation, before I came in-house last October. So I want to, again, just encourage anybody out there who's got questions, who's trying to learn, who's trying to implement the process into their own portfolios, whether it be professionally, personally, in a family office, et cetera, et cetera. I mean, this is a time for us to all get together and to communicate and to learn from each other and to build and to strengthen each other. So this is definitely an open forum, right? So again, if you want to ask any questions, if you're not comfortable speaking, that's totally cool. Just shoot me a DM, or it's probably easier just to tweet it underneath this kind of handle, right? So just tag me or whatever. I'll do my best to kind of answer questions and to monitor any questions that may arise from kind of the tweet thread. So with that, I want to start this session off. I think the top three things, if we kind of continue on that theme, which I felt has been pretty good for the last couple of weeks. It's going to be gold, which is really gold and rates, and then really volatility and signal strength, aka things that have been bullish trade and trend, certainly have been losing their bullish trade and kind of coming up pretty close to losing trend as well. So just want to that's kind of the top three things today. So again, gold / rates. You're going to have some volatility as well. It's been a key theme the last few weeks. And then we're going to touch base as well on signal strength and things that are losing signal strength. So in terms of gold, this question came up from a subscriber earlier today, and I want to thank, I believe it's Justin. So Justin, really appreciate you pinging kind of Todd Enders and Todd. You do such a great job in terms of communicating and sharing your portfolio, the moves that you're making with Hedgeye Nation. So really appreciate all that you do, buddy. So again, just kind of from us to you, thank you very much. But from the question really was like, okay, gold's at the low end of the risk range, dollar and rates are at the top of the risk range. What are we thinking here? Like, the question was kind of like, what is Todd doing? What are we doing? And as much as like, yes, like gold remains bullish trend, but it's lost its trade momentum, right? So it's bearish trade, bullish trend. And gold in particular, really has a very strong inverse correlation to real rates. And real rates are up almost like 25% in the last month since kind of like, call it late July. So we're sitting at a real rates environment that's significantly different than we were looking at a month ago when we were very bullish on precious metals, and we had exposure to GDX, GLD, silver, even the junior miners at one point a month ago. So we've dwindled that exposure down, and we actually booted silver on Monday, and we got out of GDX a week or two ago, and junior miners at least 2 weeks ago. So we're down to just like a gold position, and even at that, we're at a minimum size on the gold position. So what I mentioned to Justin was that there's sometimes like as much as like we want to have gold in portfolio, and it's a great kind of quad 4, quad 3. Typically it performs well in a quad 3 and a quad 4 environment. There are often times where there's other places to go hunt and other places to go look and to go to add to or to expand your exposure to within the portfolio. And my example was really energy. So, energy has been probably one of the best signal strength longs out there for a month plus at this point. And you've had a little bit of a pullback in the last day or two. So this is a great opportunity to be expanding your portfolio allocation towards energy-like exposures, whether that be XLE directly through US, from the US equity side, uranium, XOP is another good example. Again, that's an equity, USO just as an example in terms of just commodity related itself, the WTI exposure. But in general, the general grasp here is, yes, like having an exposure to gold is part of the process, but it's kind of like a understanding when and where. And this rates environment that we're in is very unique. And you've seen yields, U.S. Treasury yields, move very significantly over the course of the last few weeks. And, the 10-year and 30-year are pushing. I think there's the 10-year closed. Let me just pull it up. 10-year closed at 4.26, and the 30 years at 4.36, and the 2 years at almost 5 at 4.97 currently trading. So I think those are actually live prices. But my point is that we've had a huge move, and it's really a different real rates environment than what we were seeing just a month ago when real rates were, closer to, call it, 140-ish. So, we were sitting around July 25th, we're sitting kind of around, 1.5 on the real rates. And now we're sitting closer to, north of around 1.8, right? So, that's a big change. It's almost like a 25%, difference from where we were in July versus where we are today. And I think that's something that you really got to be conscientious about and understand that as much as, precious metals and gold exposure, again, works well in quad 3 and quad 4, and we want to have things that work well in quad 3 or quad 4, or that are, pushing into quad 1 environments like Japan. We were adding to that today across the board, across all 4 of our exposures. This is like part of that portfolio construction and understanding that sometimes, although it's still bullish trend, it's not making higher highs and higher lows. And you saw that from the trend risk range that was published on Monday, as a lower low and a lower high on the GLD. And so these things are things that we got to, you got to be kind of conscientious about and kind of pick up on, because it's going to help formulate and construct a better portfolio. And you're going to have pieces of inventory inside of that portfolio that are really trending in the right direction. And that's kind of the whole, a good chunk of this whole thing is like trying to get, winners on the board and sizing them up to a max size position so that you can, maximize that exposure, maximize the trend in your favor. So just kind of wanted to touch base on the gold and rates environment itself. This rates environment, and even with the dollar, pushing on the top end of its risk range, these things are all kind of, everything's sort of moving in conjunction. So I'm going to kind of skip ahead to the third topic, I guess, which was, things breaking down altogether. And you're seeing, if you think about it in a converse manner, you're seeing with the dollar and U.S. yields pushing to the top end of the risk range and, moving together. So like dollar up, rates up. And that, as Keith would say, and as he's mentioned in many top 3 things on the macro show, dollar up, rates up, gold down, right? So that's sort of something that you're seeing. And in addition to that, you're seeing breakdowns in the S&P and the small caps and The NASDAQ, you're seeing breakdowns across basically sectors, right? I mean, on a week-over-week basis, there's not a single sector that's green on the board. The top two that are the least down are healthcare and energy. Luckily, we are, we do have exposures to both of those. But in on a 1 month basis, those are actually the only two that are positive and green on the boards still. So, but you're seeing breakdowns and basically, trade breakdowns and in some cases trend breakdowns and reversals. And it kind of started last week, but it certainly has continued this week. So just kind of wanted to highlight that, right? And, if you do see some dollar weakness, then, just be conscientious and be aware that the signals could kind of shift, right? And like the same thing in terms of what we've seen to the downside, we could see to back up to the upside. Now, is there a sustained upside movement? I don't know yet, but this is just things that I'm thinking about and the signals that I'm observing and how things are all really kind of trading together. And even now it's kind of expanded to EM. And as much as the last 2 weeks, I've been talking about kind of like EM ex China, and that's been a great place to be. And we'd be continuing to, increase our exposure to those areas. And, you've been seeing Keith do that in his re-ranked product in the Mucker family office. Today, he actually sold all of his Singapore. He took down a pretty good chunk on Brazil. He did add to a bunch of Japan, right? So Japan continues to be a top asset allocation for us. And I think this is where kind of the dollar exposure can, with continued strength there, it adversely impacts obviously EM. So we're kind of reducing to some of the sizing that we had. And I see Trent Wizzo out there. I don't know if he can speak, but a couple of weeks ago he was on with Mike T and I. And we were talking about, India and Japan and South Korea and Brazil and Israel all being kind of like really, really great places to be. And, some of those do remain, longs in the portfolio. But South Korea, for instance, is no longer, that signal has lost its strength and has been booted out of the portfolio. As I mentioned, Brazil was taken down by 100 basis points today by Keith, which is a pretty big move for him. And we were also completely out of Singapore and no longer in the Philippines either. So these are all things to be kind of paying attention to and understand that, this could be, again, like just with this complete breakdown, you had a portion of 2022, certainly at the beginning where of the year in the first quarter or two, where you had the only real exposure you could have on were dollar and energy trades. So could we have a repeat of that? I don't know, but certainly on my brain here midweek. And interestingly enough, I came into the week thinking that that oil had sort of looked like it was getting a little kind of toppy, to use the lack of a better word. And we did actually have seen that pullback, but it's actually kind of pulled back to a pretty good level here, and we've been adding to that exposure in anticipation of continuation of that kind of higher for longer inflation and higher for longer rates as well. So that's those two things. And then just want to get into volatility as well. And I will welcome you to the stage, but let me just finish up on my kind of volatility component here. So again, VIX is, closed the day at 16.77. You're seeing volatility across the board, both the VIX and NRBX, both are back into the low 20s. So, really a different rate, volatility complex and exposure that we've seen for the last, call it 2 months, or at least since kind of like the end of May. So these are just things that to really be kind of being paying attention to. The move is down at 117, but still, as I said, like very elevated and not very conducive to trying to get long or try to pick a bottom in rates, whether it be through TLT or IEF, et cetera, et cetera. So rates are really kind of like a no-go zone at the moment in terms of just like, fixed income, US fixed income exposure. Similarly, you've seen, OVX has kind of increased again, but we're still, like last week, we're still kind of, we're sub 30, closed at just north of 28.5. So this is, so that's again, that is a very investable bucket for oil. So that is a good thing to see. And when you see price down oil volatility up, but not like exploding to the upside. And if you get at the kind of the low end of the risk range or in the bottom third of the risk range, that's a great time to sort of add to that exposure. Same thing with GVZ, right? So, excuse me. One thing that is good to see on the gold vol, even though it's basically acting inversely to real rates, you haven't seen gold volatility really explode to the upside. So it's been a pretty sort of slow grind lower over the last few weeks, which isn't the end of the world. And again, as I said, it's still maintaining a bullish trend, but just bearish trade at this point. So keep an eye on that online gold volatility. If you do see that start to explode higher, then or start to move higher, like north of 14, then you may just be the kind of the beginning of something, or it could be the beginning of something in terms of volatility up and price up, and you can see a reversal here in the gold price. So just want to kind of touch base on volatility. It's obviously been a big component and a huge focus over the last few weeks. I think with VIX certainly putting in kind of almost a new trend here in terms of not sniffing sub 14 for the first time. It seemed like almost every week we would hit sort of 14, we'd be trading kind of under 14 and a half for almost all of June and July. So definitely a bit of a different VIX environment here, and it was VIXpiration. So just to call out, we do have OPEX now on Friday, and but VIXpiration really didn't kind of have a whole huge impact. I would say obviously there was a bit of volatility around the FOMC minutes that came out this afternoon at 2 p.m. But again, typically with that VIXpiration, you do see a little bit of vol suppression coming into the day, which we did get yesterday a bit, but not much of a continuation today. So I think in this case, I should say we got some vol suppression in the morning, and then it sort of moved higher. I think and it closed. Tuesday. Yeah, closed at 16.545. So we've been kind of living in that 16.5 range for a bit. And again, just to kind of call out, and I think many have probably heard me say this or heard us talk about this. And I know Chris Moore, our 1000 FX, has talked about this numerous times in terms of kind of thinking about the risk ranges and almost in thirds, and acting on the top third and the bottom third, and the middle, you're kind of just like observing and kind of doing a bit of an orientation, right? Like what's transpiring and that kind of thing. So VIX is certainly in its top third component at this point in time. So just kind of wanting to call that out. You could see it go down to the bottom end of the risk range, which again, if you get kind of a little bit of a weakness day in the dollar, volatility moving to the bottom of the risk range, you could see a pop here, or a general kind of uplift to the U.S. equities market environment that we've where we've seen. I think we've only had one up day so far in the month of August. So definitely a bit of a different environment than what we had been used to for the first half of the year.
Robert McGroarty here, Director of Subscriber Development at Hedgeye. Join our entire research analyst team live before the market opens for deep dive investing analysis, our favorite stock ideas, and our risk manager in chief, Keith McCullough's macro overlay. Our team of 40-plus equity analysts discuss key market developments, trends, and our high-conviction long and short investing ideas. You will not get this granular level of insight anywhere else. A video replay, audio version, and analyst summary notes from the call are available shortly after each live show to ensure you don't miss anything. Go to hedgeye.com/research to subscribe. And tune in live to the call weekdays at 7:45 a.m. Eastern. Enjoy the rest of this episode.
But Wheat, it's a pleasure to have you up here. I think you might be a first time caller.
Hey, thanks for bringing me up. I'm much appreciated. I have a lot of respect for Hedgeye Nation there. So thanks for letting me talk here. Just a couple comments, right? Like you talked about volatility being at the top of the risk range, right? And that's an interesting framework that you have, right? But one of the things that I've learned about volatility is that you have this degree of volatility begetting more volatility. So there's this autocorrelation component to volatility that it can feed on itself and drive itself higher in terms of like vol just producing its own momentum higher there. So I would say that vol's an interesting space to be, discussing there. So that's point number one. Point number two, I wanted to just briefly say, if you look at the short side of the portfolio, I think there's a lot of alpha to be had, especially in autos. If you look at Carvana and Tesla, for example, down consistently, and we're at the top of the risk range, I would say, on that one, because effectively these companies have run so far and they've divorced themselves from their underlying economic fundamentals that you got a lot of alpha potential on a put spread strategy there. Thanks for letting me talk.
Yeah, absolutely. Yeah, no, it's a good call out, and yeah, you're spot on in terms of volatility can definitely kind of compound on itself, and I do think we are in, we're kind of at the top end ish of the investable bucket, right? So that, just to remind everybody that that's basically sub 19 or kind of 18 and below, and then so we're sitting kind of just around 17, right? So this is definitely kind of on the way to the chop bucket, and I think you've been seeing that where with negative gamma and over the course of the last few days, was that negative gamma, it can go kind of another direction, but certainly has been more so leaning to the downside, and any kind of downside, kind of momentum or pressure has begotten that kind of flow or that price action to the downside, and conversely, you're spot on. You've seen kind of VIX, kind of take a cup of coffee down in the call it 15 or sort of arena, and then really kind of not with everything else going on, it sort of picks up steam back, picks back up steam, and starts kind of moving to the upside. So that certainly seems like we're in a bit of a new regime, COCO regime for volatility. Now it doesn't mean that we can't get back down to kind of the low end of the risk range and maybe pushing down, as I said, kind of sub 14. But at this point in time, I think kind of acting, weed, as you said, kind of positioning yourself and preparing mentally for sort of certainly much more of a choppier environment, and one where volatility is potentially on the rise, right? So it's a really good call out, man. And you're right. I mean, Tesla, I don't really track Carvana all that closely, but I just pulled up the ticker, and that one obviously has really come off its peak here in July, August, which was call it mid 50s here, and yeah, sitting at 38, but with a lot of downside from where we were just in May earlier this year at call it $8. So a lot of alpha to be had.
The quicker they rise, faster they fall, especially with Carvana. If you look at the underlying fundamentals, if you do a deep dive on that, you will find some very peculiar accounting and financial relationships that on the executive management side of things. I'm not gonna say too much, but there is an enormous elephant of risk associated with both those companies there, especially going into October. Like I personally, I have a view that October is going to have an elevated vol month. If you look at historically when big sell-offs have happened in financial markets, they've happened in October. 1929 stock market crash, that was an October crash. The 1720 crash of the South Sea bubble, that was an October crash. 1987, also sell-off, October crash. So you got, October is a peculiar month from a stock trading perspective, because I feel people are a bit depressed because, the days are shorter and only becoming more shorter. And you got a situation where going into October, you're going to be looking into Q4 earnings estimates, and maybe you're revising downwards, and that can lead to more vol or lower pricing regime there.
Yeah, for sure. And I think the only kind of call out I'll say on Carvana, and I think many here on this call would agree with you in terms of the overall fundamentals, but sometimes just from a flow standpoint, there is, from my calculation here, it looks like about over 35%, almost 40, numbers 37, spot 33 to be specific. Is the the float that's short. So it's a very high short interest name, and that is a big. So again, just kind of be cognizant in terms of what you're getting into. And there's a free site called FinViz where you can kind of punch in the ticker and get a lot of the different kind of components here. That's what I use in terms of trying to just track look at short floats and other ratios, EPS, all that kind of stuff. So just kind of wanted to call that one out there in Carvana. You can see that a lot on some of these names that have rallied really hard kind of in the last few months. The portion of that it could be related to sort of some short squeeze action, but just my main point is really not a comment about short squeeze. It's more about just understanding kind of what bed or which hotel you're staying at, right? So if it's a crowded kind of hedge fund hotel name, then there could be kind of, although the fundamentals and the overall kind of thesis on the investment is sound, you just could get kind of accidentally run over if somebody's kind of trying to if their book's getting rejiggered or what have you, right? And so that can happen. So that's the only kind of caveat I'll say with Carvana, but at the same time, that's if it even just that's it even goes like just half where we were generally in 2022, you've got $10 to $18 downside. So all right, so there's again, speaker floor is open. There's a lot of great talent out there. I've seen Tim and Wasim and Pokey, Muni guy, Trend. You might have the baby tonight, but yeah. So just floor is open, guys. Let's maybe have some conversations around. I think FX is certainly an interesting one. So again, as folks maybe consider jumping up, I'll just kind of go a little deeper into the dollar and the related sort of other currencies. So one that's certainly from a signal standpoint, and that's really what this notebook review is all about, is assessing what we were looking at over the weekend, kind of coming into the week, and then how things have changed. And the Euro USD was really starting to lose signal strength kind of coming into the end of last week, and that's only continued to improve to the downside. I don't know what the best way of explaining what that is, but basically that weakness in the signal in terms of the euro itself has really just kind of picked up steam to the downside. So that's certainly one that's ratcheted up the my radar or my screen in terms of perhaps adding the euro to the short side on any kind of strength here on say, let's just say you get a little bit of a dollar weakness for a couple of days, that's likely going to give you potentially going to give you an opportunity to add to some crosses that we like, including both Japan's been one that we've been, I guess, long the US dollar versus Japan for many months now, but the euro is certainly one that's crept up the board, and I think that that setup is looking really, really good from the short side there on the euro. I think the other component to that is the Great British Pound. It's kind of interesting that it's kind of hung in here. So again, just kind of a little bit of a call out. That signal, although it had been weakening, it had been one of the stronger kind of FX crosses out there in terms of pound versus dollar. It has come back and it has weakened, but it's not in kind of the same, I guess, weakening mode as the euro. So just kind of wanted to touch base on those two for the time being. And then, again, let's get the conversation going. There's a lot of things that...
Yeah, no, absolutely, Rob. I would just to add to that, I like your idea of being short the euro in particular. Like going into this winter, you can, there's a lot of risk with the euro because you got a situation where all of Europe's energy needs are not necessarily secured if they have a cold winter, especially December, January timeframe. And that can create its own sets of economic challenges around cutting energy flows to industry in order to preserve the human capital stock, if you will, right? Mm-hmm. So effectively, America looks to be hiking again in September. So you're getting a bit of a pickup on interest rate differentials as well.
Yeah, 100%. And I see Wasim, who's a good friend out of Canada. Yeah, that Canadian dollar it looked like it was going to be doing something coming into the end of July, and it's just sort of rolled over. So it's kind of an interesting dynamic there on the Canadian dollar versus the USD, and especially in the face of what's been transpiring in the energy complex. So Wesley, just kind of wanted to call that out for you, and any of my other good Canadian friends. I'm going to be traveling. I'm traveling to Canada on Friday. Going up to see my folks next week at the cottage for gonna spend some time on the dock and the lake and that kind of thing. So obviously, I think as everybody knows from the risk range, it's certainly the CAD USD is back to bearish trend, and it's it certainly has kind of I want to say fallen out of bed but from an FX standpoint, it quickly moved from spot 755 down to spot 733 as of tonight. And yeah, it's just been kind of it's a move what seemed that I wasn't, really expecting given the strength in the energy complex and stuff like that. So that's definitely kind of another signal to kind of call out and a bit of a divergence given, what I guess kind of traditional correlations have been between, the price of oil and the Canadian dollar. So just one call I went out to. Trend.
Yeah, absolutely. I would just add to that. I would say the Canadian consumer is exposed on real estate. We've gotten way over our fees, and especially with regards to interest rate sensitivities, we're far more interest rate sensitive than America, right? So arguably that is a major negative for Canada. But if you look over longer periods of time, if you want to expand your time horizon to, let's say, 3 to 5 years, arguably the Canadian dollar is poised to do well if you expect underlying political tensions in Europe causing a bit of an outflow of migration into Canada and the United States. Canada is well positioned to pick up those wealthy immigrant flows coming to Canada looking to escape maybe some political volatility happening in the Eurozone. And our country is only 40 million people. So if you look at all of Europe is close to 500 million. So even if you just take the top 10% of the wealthiest Europeans, that's 50 million people. So even if Canada even received just 1% of the top wealthiest of Europeans, that's still 5 million people. That can greatly impact our economy and grow the consumption basket, if you will, and productive capacity as well there. So I say longer term bullish Canadian dollar, bearish euro, because ultimately we have the ability to feed ourselves and provide energy for ourselves, right?
Yeah, absolutely. Yeah, I mean, to play devil's advocate, one would say that if that's the longer term view, then you basically still want to stay along real estate. there's only so much.
Absolutely. You're right. Correct.
So much real estate in terms of like
there's a limited downside.
Like good real estate, inhabitable. It's all inhabitable, but you know what I mean in terms of like quality.
The desirable real estate. And there's only a limited market. And that's what really makes America so special as a country. Is you have such a vast amount of highly desirable places to live that are productive. You got good farmland, you got beautiful deep sea ports, you got energy, you got agriculture, you got the deepest well of technical talent in the world, and friendly trading partners to the north and south. So arguably America wins even more so than Canada.
Yeah, this is Weekly Notebook Review, also known as the World Economic Forum, which is here to solve all the issues for everybody. But that's a really good comment. I appreciate it, buddy. Thank you for jumping up. You're so far you're the only one. So again, I'm not gonna beg people to come up here, but if you want to talk, process, you want to talk shop, you want to talk portfolio, construction, allocation, what you're seeing out there. I mean, this is the forum to do it. This is, I'm certainly here to help. All of Hedgeye Nation's here to help. So, X2's
Have you thought about?
Hey, go ahead.
Have you thought about shorting the Chinese renminbi? I know the liquidity might be a bit of an issue there, but it seems like we're going to have some real fireworks on an FX side of the business there.
Yes. Yeah. So you talking about, So like USD, CNY basically.
Yeah. Straight up. Yeah.
Yeah. I mean, we're right at the top end of their traditional band basically. So yeah, I mean, it's, I kind of wish, so one of my very good friends is Chris Moyer, who is, otherwise known as 1000RFX here on Twitter. And he loves whenever we get the extremes on the CNY, or NIMBY, he loves to call out Kyle Bass, and he always jokes about how there's probably going to be a new Real Vision Kyle Bass special because of the extremes that are happening. I don't really. I'm going to be perfectly frank with you. I follow the renminbi from just a purely technical or kind of a purely observational standpoint in regards to understanding what it's doing on a week over week, month over month, 3-month basis, 1 year, et cetera, et cetera. So I follow it from that standpoint. I do not trade the US dollar CNY. But I obviously, I am aware of what it's done in the last, and the move it's had, and clearly, obviously very, follow very closely, and we are short China in general, right, in the Quad 4 environment that it has on its horizon. So yes, I mean, I think it's a very interesting setup. I think it's a very interesting setup. So I kind of shy away from it personally, because it's a relatively manipulated currency. Obviously, most of China is. So I don't think I have an edge.
Yeah, fair enough. Yeah, same thing with the USD Japanese currency. I feel there's that central bank tries to run over currency speculators, so it's arguably you got to be careful there.
Like $1 trillion players that are and X2 could talk about this better than anybody, but you've got massive players that are have the yen trade on in some capacity, right? And so it's a crowded space. And one So anyway, X2.
Have you thought about?
Good, man. No, go ahead.
Oh yeah. Have you thought about being along the Mexican peso versus either Canada or euro, for example? That's really interesting because the peso is strengthening even relative to the American dollar, which is has a longer term bullish sort of strengthening trend. So arguably peso could even outperform USD. So if you take a peso versus euro pair trade, that could be really, really interesting.
Yes. Mexican peso has been an outperformer, or has been an interesting component here for probably the last 18 months. I think we were actually, I forget who it was, but somebody brought it up on a weekly notebook review last summer as well, as it was sort of kind of making moves against the US dollar. And it's continued to be an outperformer. And again, I'm going to give a huge shout out to my boy 1000RFX. And he's mentioned this here on WNR before in terms of the rate of change of what's happening in the central banks. I think that's playing a big role in regards to what's transpiring in the currency environment. And I think that's one of many reasons why the dollar has picked up steam in the last, basically ever since the FOMC meeting, really. And it's because there's more rate hikes that are on the horizon. Now, again, the rate of change standpoint in regards to the hikes is not as extreme as it was when the Fed was starting to raise rates back in 2022. But so it's a different dynamic there. So we haven't seen the dollar go from 101 to 110 in a hurry, but we've seen it go from 100 or 101 to 103, 103 and a half in a pretty short order. And I think this is an interesting component, right? So looking at what Brazil is doing, what Mexico is doing, what in terms of central banks, right? So keeping an eye on what those central banks are doing and the rate in which they're either increasing or decreasing their rate is certainly one that's influencing the FX market. So yeah, I mean, the Mexican peso to me is very interesting. I'm still a rookie in the FX space, so I keep it pretty straightforward. I kind of just play Euro USD and then Japan USD. So I keep it pretty clean. But it doesn't mean that that you shouldn't be looking at, peso, dollar, stuff like that. All right, so Jordan, you popped up. Appreciate it, man. Welcome to the program. Oh,
hey, thanks, Robert. I appreciate it.
I can.
I had a quick question. So I know obviously the data that comes in Hedgeye is obviously a little bit different. The model's different, but just anecdotally, I saw on yesterday the Atlanta Fed's economy now.
Yeah.
The GDP forecast went to 5%, and then I think just hit 5.8%. Yeah. And I'm sure that's going to change, but it just seems like a crazy acceleration. I'm just curious if you've seen anything coming in from the macro side that is like similar to that, or is that just like an aberration? Thanks.
Yeah, no, good question. It's obviously been kind of all over Twitter. I think that 5.8 number came in today, to be specific. Let me just find Drago's email. Sorry, I just want to make sure I have the most recent deck. That's from Monday. Yeah, so we updated the deck. Our numbers. So this is not going to reflect the nowcast, but basically, when I saw it, so as of Monday, Jordan, that nowcast model was still down at 4.12, and I immediately noticed that. I was like, oh, damn. Like the GDP now model from the Atlanta Fed is, north of 4, and then it's obviously moved basically 170 basis points from here. We are currently, that's the U.S. real GDP Q over Q, SAR projections for those that aren't kind of familiar in terms of what we're talking about. Our projection for Q3 is 2.87. So just kind of in relation. So basically the GDP now model has, as I said, has moved up to 5.8, and we're kind of at 2.8 or 2.9, call it, to round it up. But yeah, so I'm not really sure what's influencing that from that perspective in terms of the Atlanta Fed. Now they do have a tendency, even I think we saw this in Q1 of 23, where they basically cut it. I think if memory serves, they cut it almost like 100 basis points, like literally the day before the announcement came out. So, we could see some components come in terms of what we're seeing in regards to some of the data. I mean, most of it is sequentially lower. I mean, some of the positives, I guess, would be auto sales for July. It came in not up on a month-over-month basis, but up on a year-over-year basis. Yeah, so basically around plus 18. Just to call out some like the positives here, right? So monthly initial jobless claims was the consumer confidence index was sort of was a positive number here for July, and then also the headline CPI number again. But so those numbers basically are showing up as kind of like green on the board right at this point in time. But there's a lot of data to be filled in, not only just for July, but obviously there's some data that trickles in for August as well. So I really wouldn't put too much into that number from the Atlanta Fed. I don't know what some of the key metrics that drive that nowcast model, and for those at home, again, I'll give you kind of some of the key ones to be kind of thinking about, or to be kind of retail sales is a top ranked sort of feature in the model. Same with non-farm payrolls and aggregate labor income. So keep industrial production is a huge one too. So just kind of keep an eye on some of that. Yeah, like I'm sure many of you sort of already know this, but those are three that I'll kind of call out where we haven't gotten those numbers yet. I think retail sales come out next week if memory serves. But I could be mistaken on that one, so bear with me on that. But yeah, so I wouldn't put too much kind of emphasis. I will say I think I saw somewhere on Twitter, Jordan, in regards to kind of, I guess, connecting some of the dots in regards to Japan's GDP coming in at like 6%, and then the Atlanta Fed taking theirs up to like 5.8. So, I don't know what that's all about, but it's certainly an interesting dynamic. And, I wouldn't put too much emphasis on it. I would just be cognizant about it and just really understand or know that in order to have kind of an increase on a quarter-over-quarter basis, we need, you basically need to have something north of the number came in at 2.56. So you really need kind of, call it anything north of 2.56 on a quarter-over-quarter basis. So I think we're still projecting a quad 4 in this quarter in Q3, and so far the signals have been acting that way. Now there's a lot of time left on the clock in Q3 of 23, so time will tell. But that's certainly how the clock, how the game's played out so far in Q3.
That's helpful. Thank you.
Yeah, man.
Hey, Robert.
Of course, buddy.
Hi, I'm Keith McCullough, and I wanted to introduce you to my favorite product at Hedgeye, the Macro Show. Why is it my favorite product? Well, it's my show. I do that every morning. If you want to get ready for the market day, you want to contextualize all the data, you want to make good decisions, then this is what you should be watching. It's a repeatable process that you can deliberately study, measuring and mapping time series to time series of data. So it's not going headline to headline and getting whipped around. It's actually being so much more dispassionate about it and making good decisions that are data driven. So we'd love to have you on our team. Come join us.
Tune in weekdays at 9 a.m. Eastern and on demand anytime. Go to hedgeye.com/research to subscribe.
Yeah, Jonathan, what was yours? Welcome.
Hey, Robert. Thanks for taking my call, man. A couple of things on just sort of some risk range stuff. But before I do that, the GDP information you just went through, is that the number you quoted? Is that the QOQ SAR number, or is that the year over year number? I think you said it was 2.8.
Yeah, so 2.87 is the Q over Q SAR number. Yep.
Okay, so that's actually down from when you guys released the quarterly. I think the quarterly themes was in like the mid threes, maybe 3.5 or 3.4.
Yeah, it's come down a little bit. Yep, that's correct.
Okay, even better.
But that's
great.
The one that basically is the comparison to the GDP Now model that people have been kind of commenting on or touting on Twitter today. So they're basically to round it off for simplistic math, like they're basically 300 basis points above us.
Well, I think I saw there was a Twitter post where someone posted that one of the other Fed that was like 0.58, and then the Atlanta Fed was 5.8. So they just thought like, maybe someone messed up a decimal point.
Yeah. I mean,
I think the disco Fed was 0.58.
And I don't know what drives the consensus estimate number, but from what we have on our deck, the consensus estimate number is at 0.65. So, 0.65 for Q3. We're at 2.87, and again, the Atlanta Fed number that's on the deck is 4.12, but that obviously got shifted up to 5.8 today. So, so I don't know. I think it's either there's a big delta between us and consensus, and then there's obviously a massive delta between the Atlanta Fed and everybody else right now.
Great. Yeah, no, I'll take the
exactly.
Yeah. So I just into the sort of some of the nuts and bolts risk rank. Yeah. Sorry if you already covered. I joined a little bit late. But there's two things I'm looking at, and I wanted your thoughts. One is Japan, pretty rough kind of continuation day to day. And so I'm trying to figure out what to do there. And the other one is gold, which has just been, obviously getting hammered as of late. But I'm actually a little bit more constructive on that. I just don't know what you think about those two.
Yeah, so John, I
way at the bottom of the range.
Yeah, so I touched on gold at the onset. I think it's a great question, and the simplest answer is it's really being driven off the real rates environment that's transpired. So, we've gotten from what was kind of the real rates putting in a sort of 3-month and certainly kind of like a 20, almost like like it's a 3-month low there going into the end of July. And then, that is absolutely flipped to basically a high going back that we haven't seen since like 2009, basically. So the real rates environment has been a drag on gold. Gold remains bullish trend, but bearish trade. And the signal there has weakened. So you can look at that from, the gold risk range, putting in lower lows and lower highs, and especially on GLD in regards to the trend range that you get and that we publish on ETF Pro. You can see that was a lower high and a lower low, and that's like a longer look back, right? So sometimes it's a little bit easier to see things in that time frame because you're kind of looking at 3 months or more. So it's a bit of a wider band, and when those really start to shift and stop putting in kind of like higher highs and higher lows, and when you get that kind of first lower high and then maybe a lower low as well, that signal's sort of not as juicy, quote unquote, right? Not as like sexy as it had been coming into the week or into whatever, into the day, however you want to phrase it. But so gold, our precious metals exposure has been reduced, and I think like from the way that I was talking about it last week, and certainly the week prior to that, where there were kind of like 3 things that we were very much long and strong of, which was energy, precious metals, and EM ex China. And so these signals have shifted in the last 2 weeks, and most specifically in the last sort of basically in the last week, in the last kind of 3 to 4 days. And that's from an EM standpoint, we're really tightening up our net there. And Japan's kind of continues to be our biggest asset allocation. And I think that's just, for many reasons, but a big one is just like their quad outlook, and the fact that the signal continues to dictate that there's solid signal strength there in regards to the Nikkei and just Japan in general, right? So that's one, but we've reduced our exposure from other areas where like Singapore. We got completely out of Singapore today. We reduced our sizing on Brazil. So a lot of that EM, like we're completely out of South Korea, right? So like a lot of that, we are still long India. So I think from an EM standpoint, probably our biggest 2 asset allocations would be India and Japan. But these things are shifting, and EM in general, it does get impacted obviously by a strengthening dollar, just from certainly from the ETF standpoint, and then also just from EM in general, right? So so I think that's kind of what's going on in terms of EM ex China, and then obviously gold. It's a real rate environment in particular is kind of putting a drag on gold, but at the same time, I mean, when on that first sort of, I think like kind of pullback, call it, where we hit the buy button. I mean, you down like gold had like the volatility in gold has been very nominal. I mean, it's sub 13. I think it's around 12.5 right now. So the gold move itself is only like down, call it 2.5% over the last like 2 weeks or so, a week and a half. Even with that weakening signal, so it's not like it's really breaking down completely. But would I be adding here? I think the way that I look at it is more of letting it sort of like build, for lack of a better word, like kind of build a base a little bit, right? And even if I pay up a bit from where we are right now, I'll know that the signal has sort of like bottomed and hopefully has shifted to more positively in regards to putting in, some higher highs and higher lows. So that's kind of what I'm looking for. So right now in gold, we've got like a minimum exposure, and I can't say that's how Keith is thinking about it, but that's how I'm thinking about it in terms of, letting it sort of just, there's no real reason to sort of force it, right? And try to like pick a bottom, just kind of let it do its thing. And again, it's primarily driven, as I said, off of this real rates environment. And I can't, it's very hard to know at this point in time, like what U.S. rates, what the yield environment's going to do. what's the Fed going to say next week at Jackson Hole? There's just like a lot of unknowns there, right? So rather than kind of trying to be a hero, might as well just pay up an extra, pay up $1 or $2 and let it sort of actually, sort itself out.
Yeah, I mean, I've been kind of, Keith has been really, and I guess the full team, but really good on, to me, like the quad outlook for our 18 months. And I've been kind of looking, I know the signal's supposed to trump quads, but I've been, just kind of establishing my base positions. I can't trade as actively as he does around where I think the quads are going. And to me, like I was looking the last couple of days in gold as volatility is not really moving. I think there's a lot of people right now having to be forced sellers, margin calls, gold gets hit there. I was kind of looking at it as a really good time just to, basically go to my max position here. But I think what you're saying is you're not really seeing much movement in gold volatility either. I don't know if you get a risk range on gold volatility, but I don't know if you're seeing any sort of movement there or not.
I haven't. We do have a risk range on gold vol, but I haven't got it from Keith in a minute, so I don't really. For me to give it to you wouldn't really be very useful. But yeah, you're not you're correct in terms of what you're saying. I think the only component that I would probably I wouldn't say advise against, but certainly I think going to max is probably a bit aggressive. So trend is 175 on gold. The trend level is 175. We're basically like right there. So again, I mean, your downside at this point in terms of where you are. Trades up at like 180. So it's still at, and again, these numbers are like a week or so old from Keith, but this is where, and then tail is at 174. So your trend and tail levels are pretty much like right there. So you again, if you're going to take a stab at it, then there's just your downside, right, in terms of like where you're going to make a decision to kind of pull the ripcord and pull out. So I mean, like they're below into the risk range, all that kind of stuff. But Keith has not added it he added it on Friday last week, but that was the first time he kind of added back some. But then silver started to break down, and we booted silver on Monday. So the precious metals exposure has, for the most part, gotten smaller versus bigger, and so just kind of wanted to call that out.
And last question, in terms of USO, any sense of what he's thinking there sizing wise?
Yeah, good question. I don't know his sizing, but that energy in particular is one, and X2 just he had popped on to ask a question. He was like, hey, here's my question, and what is the one trade that anyone following the Hedgeye process correctly should have kind of done this week? And to me, that trade is in energy this week. So expanding your positioning to energy, to me, it was one of the best signals kind of going into last week. It maintained its signal strength last week. We had a little bit of sort of, let's call it toppiness, or just some very natural kind of pullback here to start the week. And we're kind of sitting right there in a pretty good spot at kind of the low end of the risk range. So, that to me, I think energy and USO is one to be building up your position and to be very comfortable with what you're doing there in that position. So, would you be at max? I would be at your max.
Yeah, that's what I was kind of thinking too, man. When you sent the RTA yesterday, I basically went to max, and I'm just going to kind of see how that plays out. I always get killed in trading oil. So just You know, if I'm buying it, that you should be selling.
Yeah. So, I mean, in terms of
I was just like, this is a process move. I'm just going to buy it, see what happens.
yeah, like in terms, I mean, it's the 1, 2, 3. It's the fourth position for inside of Keith's like Mucker Family Office, his long only account, right? So it basically goes gold physical, AAU, Japan value, and then Israel, and then USO. So he bought 50 bips today in terms of USO, and that kind of brought up to the list. I doubt his USO position. It's just kind of knowing the construct. I doubt it's at max, but it's probably somewhere between mid and max. Mine's at max, but I'm also kind of a degenerate. So, but that energy in particular, I think if you haven't had energy in your portfolio, or you've been waiting to sort of for a pullback, right, or waiting for an entry, this is the time. Yeah, again, I'm not saying that you might be able to get a little bit better price over the next few days. I'm just saying generally, like assessing your energy exposure this week has been a great opportunity in terms of just the signal hasn't, with everything that's going on in regards to, again, the S&P is only down like 3% basically, right? So it's not like it's massively collapsed, but, it certainly has been down a lot of days in a row. And, but you've had a big shift in terms of like signal strength and breaking down across U.S. equity sectors, and for energy and healthcare to be the kind of the two that have held up over the last week, to me is a big tell. And energy in particular, I think is one where, again, like if to use X2's kind of question, if in terms of the trade or the portfolio management that one should be assessing, that's the energy complex and the energy trade itself.
Yeah, I appreciate that. I mean, I've been probably too short. It's worked out recently just in terms of I've been short Qs, I've been short a discretionary, I've been short the Russell. I've been short the Russell for 18 months, but I've not been buying a lot of longs. I've been trying to find stuff I like, and energy is something I've wanted to add to. Japan is something I've been under allocated to. So seems like a good time to pick those up, but appreciate you taking my questions. Appreciate all you're doing here. And talk soon. Thanks, man.
Yeah, absolutely. Absolutely. And I think there's, again, like OIH is kind of breaking down a little bit versus the others, but so there's always ways to kind of like pair things off if you're worried. But I think, again, to your point, that you've got some energy longs on one side, and then you've got some shorts, whether it be small caps or some other kind of tech names, stuff like that I rolled over, or to use Wheat's Carvana comment earlier, or Tesla, right? And you've got those that they can offset any kind of potential sort of like weakness or just general drawdown, or not, just for energy to just sort of be more correlated with the rest of the market, right? So, but good comments, Jonathan. Thank you, buddy.
Thanks for the time.
Yeah, man.
Hi, Robert McGroarty here, Director of Subscriber Development at Hedgeye. Hope you're enjoying our podcast. Start generating alpha with our suite of Sector Pro investing research products. Dive deep into retail, industrials, technology, and everything in between, with exclusive access to the sharpest analysts and actionable ideas on Wall Street. Go to hedgeye.com/research to subscribe. Enjoy the rest of this episode.
All right, there had been a couple others that popped up. I don't know if anybody has any other kind of comments or questions. I see Timbo, you guys out there, Trend. I don't know if you had popped up, but I don't know if something happened on your side. All good. If not, don't worry about it. And but again, we're just going to kind of open up the floor. I'll give it a couple minutes here. Wheat's got another comment or question. By all means, buddy, go right ahead.
Hey.
Yeah.
What is your thoughts and Keith's thoughts around the defense sector allocation? I've been accumulating recently, but there seems to be a secular trend into 2024 and 2025 defense budgets are going to have to rise here. And that seems like a winning sector, even in a recession or anything. You got the government who's not going to default on payments to their defense contractors. So it seems like we got a secular growth trend here.
Yeah, ITA remains long. I mean, so we've been expressing it through the aerospace and defense ETF. And yeah, no, I mean, I think like the signal certainly backs up your overall thesis and thought.
But then you get Boeing exposure if you got that ETF, right?
Yeah. You do.
And that's a dog of a company you don't want. Oh my God. That's why, I don't know. I'm a fan of maybe picking a couple surgical names and doing it like that,
and that's fun. But honestly, I mean, like sometimes that is better. We express a lot of many of our kind of exposures through the ETFs. But yeah, it doesn't mean you can't kind of go inside the ETF and go pick out some things that might suit your or kind of meet your criteria a little bit more specifically. I think that's probably a good call out.
Yeah, just to add a little bit of extra context to that, Robert, part of the reason for the relative bearishness on Boeing is they still have the same management and executive team largely as when they had the 737 MAX scandal, right? That plagued them. Like there hasn't been a meaningful executive change other than the CEO. But other than that, there has not been a meaningful shakeup there. So confidence in management's ability to execute is relatively low, and there's still underlying issues with regards to unsold inventory of those jets that are still on ramp lots there. So bit of a dog with fleas, to use a reference there.
For sure. Yeah, no. Yeah, I'm familiar. In terms of so I was just pulling up key single strike stocks, just trying to see if there's anything in the top. Nothing's really broke. We don't really cover that many defense stocks, so
maybe that should change, Robert.
We should.
You should spearhead the change to say, hey, this is going to be a secular growth trend, because effectively what you've seen up until now is we've had what politicians say, like there's been a peace dividend of declining military budgets globally, and even in the United States relative to historical spending levels, because after the fall of the Berlin Wall, and after the collapse of the Soviet Union, you really didn't have these national strategic level threats, right? It was more funding counterterrorism missions. Mm-hmm. But now America and NATO is being challenged on a global stage by Russia, China, call it Iran, and that threat can persist and grow over time. So secularly, you're going to see enormous spend. Like just Japan doubled their spend on military relative to GDP. They just announced that 6 months ago. And that's gonna the trend is in one direction, right? So I think I've talked enough. Yeah.
No, I'm excited. I mean the top five. Well, yeah. I mean, there's a lot of communications. Like names that folks would be familiar with, like Meta and Google and Match, stuff like that. So and then there's some tech names and some of these have consumer staples, right? So Celsius Holdings, CELH, that's up in the top 30 or 32, excuse me. So yeah, so there's definitely some. It's an interesting. This list comes out, it gets sent around on Sundays to in-house, and this is so there's, again, just for folks to communicate. I mean, there's DraftKings has been on there for it's had the longest in terms of time held and versus signal strength. So yeah, DraftKings and Meta obviously is number 2, but then you got some new stuff like like Celsius and Amazon, and EDU actually out of China. So it's a bit of a I won't say mixed bag, but it's quite a diverse list. Everything from Constellation Brands to J&J to Johnson & Johnson. So that's kind of, again, that's all driven off of our coverage list in terms of our sector heads. But I think so there's definitely things to be had. But you raise a good point in terms of, there is a great component there in terms of going inside the ETF and looking at the top holdings and then making a judgment call for yourself, right? In terms of, do you want to be long the ETF itself, or do you want to try to pick out some of the underlying components and, kind of have better, quote unquote, better exposure or more pure play exposure to that sector and that kind of thing. So definitely something to be thinking about.
And any short exposure on utilities here? Like, for example, Hawaii Electricity Company, it appears to be filing for bankruptcy. And in addition to just that company, if you look at a macro level, cost of capital is rising, and these are capital-intensive, debt-laden businesses that seem to have enormous exposure from a risk standpoint, but limited ability to pass through price increases because of the politicized nature of electricity.
Yeah, I don't really have a view on Utes. All I know is that it's bearish trend, and utilities have been a dog. So
yeah, they can continue.
We've been short, and they'll probably continue. I mean, if this rates environment holds up, right, they're going to be they're inversely correlated to that, and it's kind of like, again, I don't always get deep into the weeds on the companies inside of them, but Utes were up a little bit today, and that's kind of, they haven't had many updates in a while, but I think if I pull it up, they're like the worst performer, I think, on a 1 month. No, REITs and tech were worse, but on a 3 months basis, sorry, 1 second. On a 3 month basis, they are the leader of the pack in terms of the worst performer, down over 6%. And then you had consumer staples at down almost 4%. So everything REITs, Utes have not been very strong as of late. And this goes back to kind of one of the conversations that Mike Taylor had when he was on a couple of weeks ago, in terms of the companies with pricing power, right? And I think that's a really important comment and idea to be thinking about in terms of portfolio construction. Is companies with pricing power, they have better opportunity and better ability to maintain their margins versus those that don't have that capability, and therefore they will likely need to bring down earnings, take down guidance, et cetera, et cetera. So I think this is a big component. I don't know if utilities fit into that bill to be, I haven't really done enough due diligence on that yet, but I think that's just generally a really good concept to be considering as we have stickier inflation and kind of higher for longer inflation and clearly higher for longer rates. Where do we have, who has pricing power, right? And where is that coming from? What does that look like? How long can it last? And that kind of thing. So, will utilities kind of, again, I don't want finding a bottom doesn't really matter, but like, will it show up in their earnings, right? With higher energy costs, whether it be, if natural gas sort of, picks up steam or what have you. Again, I'm just talking about like U.S. general kind of utilities, right? What does that look like? Do they have, what kind of pricing power do they have? Can they keep them elevated? I think it is, they're very interesting where, the utility companies are certainly very quick to increase the cost to the consumer when input costs start to rise. But as input costs decrease, the pass-through certainly doesn't happen at the same speed and the rate of change in which they're sort of enjoying the higher margins is quite comical to me. So that's not really a political statement. It's just a matter of fact. When when that gas goes to 7, you certainly quickly see it in your bill. But when that gas goes from 7 to 3, it doesn't really get reflected as quickly as you did on the rise. So I think these are certainly good things to be considering, to be thinking about, not only in the consumer discretionary space, but certainly in utility, pretty much throughout every sector, whether it be energy, utes, real estate, et cetera, et cetera. So I think it's if you haven't listened to that conversation, he was actually on back-to-back weeks, and both were great. So one week we had Trent Wizzo and Mike Taylor and myself. Then the following week it was really just Mike Taylor and myself. But those are all up on the Hedgeye YouTube channel, the podcast channel. So again, if you are listening to this or kind of wanting to listen to the replay again, you can catch those. Will all be up on across channels tomorrow. And then I'll be remiss to say to mention Hedgeye Regional Las Vegas is coming up in a few weeks now, or basically a month out. That's happening on September 12th in Las Vegas. It's going to be a great time. So again, if you're interested, please go Google Hedgeye Regional Las Vegas, and all those details will be there for you. So I'll open up one more time to the floor. In terms of anybody, or back to Jonathan Wheat. You guys have had some great comments and questions this week. But again, if anybody's out there, if you guys have any questions or comments, I'm happy to address them. And if not, we'll just kind of wrap things up tonight. Any parting words, Wheat to Jonathan? Oh, Ben's coming up.
Yeah, I would say in general, winners tend to win, losers tend to lose, right?
Yes.
So, I tend to think there's a lot of fancy quantitative type of investors do sort of trick themselves into momentum-based in investing, and with maybe just the tighter tolerance around risk. And that's an interesting concept just to leave your listeners thinking about there.
Yeah, absolutely. Ben, welcome.
Robert, sorry, I was having a bunch of technical issues earlier. I was trying to come up. Wonderful website. The one kind of comment or question I had, and I was really hoping 2x or 2x4. I was really hoping you'd be up here for this, but kind of going way back to the beginning on the currency trades and things of that nature. When you look at the rate of, or just not even, that's not kind of the rate, let's just call it the trend of inflation in the UK versus the EU. I feel like it's pretty clear that EU is like in a really bad spot, because like they've had like these like kind of small downtrends like in their inflation data, whether it's like headline or core, and then it just pops right back up. And it's kind of like in that one of those little like downtrends again right now. But it's still way worse off than the EU as a whole. And it's a little ironic to me too, because they kind of painted themselves into this corner when they left the EU. God, like I said, I was really hoping 2x4 would be up here, but that's just kind of something I'm watching as far as a currency trade goes, is the kind of shorting the pound versus the dollar, because just with their inflation where it's at, and of course given like their mortgage, like the economy around like their mortgages there, because they will kind of work on that adjustable rate system the way a lot of those countries do. Like I'm just kind of thinking like it's a matter of time before the pound goes back under parity.
So it certainly lost signal strength as of late. That it's neutral on the board at the moment, right? So that had been bullish just, I want to say probably 2, maybe 3 weeks ago. But I made a comment earlier that it's sort of unlike the euro, which sort of just keeps going lower, right? The pound has found kind of a floor here around, one spot 2.7, call it one spot 2, 2.6.5, realistically. But but yeah, I mean, you're not wrong in terms of the inflationary environment and the wave of upcoming sort of mortgage repricing of the mortgage rates and stuff like that, right? In terms of payment schedules and they like Australia and many others, even Canada, I believe it is, are on kind of typically somewhere between a 3 and a 5 year kind of mortgage cycle in terms of like repricing of their rates. So yeah, I mean, I think time will tell. I mean, at this point in time, I mean, the pound is not breaking down in terms of saying that like that they're in a lot of trouble, but at the same time, that it might not take a whole lot for it to do so. So I think just keep an eye on it for now. I mean, neutral on the board is usually a kind of wait and watch situation. And as I mentioned earlier about gold, to kind of start the show, I think that's one where there's not really a need to kind of force anything in that regard on the pound versus the dollar, and especially given that the Euro USD setup is giving out a much weaker signal and therefore a much easier sort of like negative or bearish trend to be pouncing on. So sometimes it's less about what we think then and more about what is actually going on out there and
what the tape says.
Easier prey. The easier prey,
I don't disagree.
Yeah. But it's a good comment, man. And I think, keep it on the board, bring it back up. And I'm about the holiday next week, so it won't be a week in the book review, but we'll be back kind of before Labor Day. And yeah, let's talk about it in like 2 weeks. And maybe that signal's changed and it's the beginning of a new, to your point, kind of a new trend lower and back to parity. I don't, but we'll just kind of see what the tape says and what the signal says. All right. Well, with that, thanks again for a lovely weekly notebook review. Always a pleasure to speak with such excellent members of Hedgeye Nation. And as I mentioned, we will be off next week. I'm going to take a little holiday, spend some time up in Canada with my folks and the family, and then we'll be back the Wednesday before Labor Day, which is, I want to say it's August 29th, but just pull up the calendar. No, it's the 30th, 1 day off. So we'll be back August 30th, and it could be an afternoon session. Might be able to sneak in, get it back to kind of that 4:30 time slot, but I'll obviously give everybody plenty of time. Hopefully you appreciated kind of getting the announcement on Monday this week. I'm trying to be a little bit earlier on terms of getting that out there for folks to plan. But again, thanks everybody for their time tonight, and we look forward to seeing where signals take us. So let's keep preparing for the end of the rest of this week, next week, and the rest of this month. And all of a sudden, we're going to be halfway through the quarter, which is going to be kind of crazy to think about. But school year started back up in a few weeks for us here in Massachusetts, and all of a sudden, it's going to be Christmas, boys and girls. It's going to be crazy. But we just got to take it sort of one step at a time and think through portfolio construction and signals that are in front of us. But so with that, thanks everybody for joining. Oh, Roland's coming up to talk. Hold on. Roland, you trying to sneak in here? Roland, did you accidentally hit the speaker button?
Yeah. Thank you once again for holding the venue, Robert. It's just a pleasure that you're humble and that you're keeping everybody on board. And I greatly appreciate it. Thank you so much.
Roland, I appreciate that very much, buddy. And no, thank you. And we'll, but this is, this show is always for the people, for Hedgeye Nation. It's for us to all get together, as I said many times a night. It's so I just want to encourage everybody, we'll come back in 2 weeks, come prepared. I mean, this is all about having
the dialogue with each other and learning from each other. I learned from from you guys. I mean, Jonathan came, and we both had some fantastic commentary and questions. So it not only sharpens my game, but also hopefully helps everybody listening in. So with that, Roland, appreciate it, buddy. Hope you're well, and I look forward to seeing you soon. But let's rock and roll out there. I mean, it's a fun time. It's a fun time to be alive. Fun time to be alive. Let's go. Let's go make some money. All right. Have a good night.
Don't forget to check out Hedgeye.com to get more actionable investing insights from our team of more than 40 research analysts. And check us out on Twitter at our handle, @Hedgeye. This presentation is informational only. None of the information contained herein constitutes an offer to sell or a solicitation of an offer to buy any security or investment vehicle, nor does it constitute investment recommendation or legal, tax, accounting, or investment advice by Hedgeye or any of its employees, officers, agents, or guests. This information is presented without regard for individual investment preferences or risk parameters and is general, non-tailored, non-specific information. This content is based on information from sources believed to be reliable. Hedgeye is not responsible for errors, inaccuracies, or omissions of information. The opinions and conclusions contained in this report are those of the individual expressing those opinions and conclusions and are intended solely for the use of Hedgeye subscribers and the authorized recipients of the content. All investments entail a certain degree of risk, and financial instrument prices can fluctuate based on several factors, including those not considered in the preparation of the content. Consult your financial professional before investing. The information contained herein is protected by United States and foreign copyright laws and is intended solely for the use of its authorized recipient. Access must be provided directly by Hedgeye. Redistribution or republication is strictly prohibited. For more detail, please refer to the terms of service at hedgeye.com/terms of service.